Okay, so with that said now about what money is and how it's defined, then we have to turn to the banking system. And more specifically, we need to consider the role of the Federal Reserve. And then after we talk about the Federal Reserve, we're going to talk about the general banking system, the commercial banking system that you and I all deal with on a daily basis. So, just a brief little bit of history. The Federal Reserve didn't come into existence until 1913. And basically, there had been several attempts before that, since really the founding of the country, to form a central bank in the United States, but they started and then they failed. And then finally, what was happening is that we were at the turn of the 20th century. We were having all of these banking crises on a regular basis. Basically, there was a realization that we needed a more stable banking system as a growing economy. Going back to our earlier chapters, our discussions that the banking system would also play a critical role in economic growth. So, since Congress had the power to determine the value of money, the idea was that Congress then would delegate that power to a newly created institution, the Federal Reserve. So the Federal Reserve is the central monetary authority in the United States. It consists of two parts. There's a board of governors, and these board of governors they serve terms. They're appointed by the president or confirmed by the Senate, and then that board of governors is working in Washington D.C. And then across the country is basically divided up into 12 districts, and the 12 districts are supposed to provide sort of regional representation for the Federal Reserve. So in this part of Wisconsin, we're actually part of the Minneapolis Fed. If you go a little bit further south and to the east, that's part of the Chicago Federal Reserve. I used to work at the Chicago Federal Reserve. Now, what the Board of Governors does is it directs the 12 banks that each have district presidents. It directs them what to do. And these district banks have to carry out rules in terms of lending activities of banks. So in one sense, they're regulating the banks that are in the districts. Interestingly enough, the district banks are actually quasi-public organizations. They're actually, they issue shares, and those shares are all owned by banks within the district. And they actually, the Federal Reserve pays a dividend actually back to the banks. So it's almost like a corporation. In fact, the Federal Reserve doesn't cost the federal government anything. In fact, if you look in the news, just recently we found out that the Federal Reserve, after paying all of its expenses, made a $77 billion profit that it returned back to the bank, or back to the federal government. So now, the Federal Reserve, it's got several different roles. One of the roles that would affect you and I on a more frequent basis would be this idea that it actually provides check clearing processes, right? So if I write a check to someone, it is processed by the Federal Reserve. Make sure that the right account is debited and the right bank is credited. It acts as a bank for the banks themselves. When a bank wants to store extra cash, store extra deposits, it does so at the Federal Reserve. The Federal Reserve also serves as a lender of last resort. Basically, when a bank can get a loan from no one else, it can always go to the Federal Reserve for a loan. As I mentioned earlier, the Federal Reserve also supervises banks to make sure that they're following various banking laws. It supplies currency. Now, the currency itself is printed by the Bureau of Engraving and Printing, but the Federal Reserve distributes it, basically. The Federal Reserve then also make sure that housing lending laws are applied. It also makes sure that basically that the economy in the region is functioning efficiently, and it then makes note of the regional economic conditions in a report called the Beige Report. So when I worked at the Chicago district, basically we would talk about economic activity in that district. A lot of farming and also a lot of car manufacturing, obviously, in the Chicago district. Okay, so now the Board of Governors has 7 members. 1 member is replaced every year. The President appoints, the Senate confirms. The President picks a chairman of the Board of Governors. That's Ben Bernanke. And it also chooses a vice chairman. Each of these individuals serves 4-year terms. So Ben Bernanke is the chairman of the Board of Governors of the Federal Reserve. Now, the district banks, so the Federal Reserve System has the Board of Governors and it has the 12 district banks. Now, across those 2 groups, there are committees that are populated by members of the Board of Governors and of the district banks. And one of the important ones that we're going to actually look at is called the FOMC, the Federal Reserve Open Market Committee, FOMC. And this is the one you actually probably hear about quite a bit. It contains all 7 members of the Board of Governors. It always has the New York District Federal Reserve President, and then it contains 4 other bank presidents on a rotating basis. And what this group does, the FOMC, the Federal Reserve Open Market Committee, is it buys and sells existing U.S. debt. That's going to be an important role that we're going to look at in the next chapter. But just keep that in the back of your mind. Now, with that Federal Reserve banking system, it also relies critically, the way in which money circulates in this economy relies critically on what's called the fractional reserve banking system. And in the fractional reserve banking system, basically what we're saying here is that banks that, like a U.S. bank or a bank mutual or even a credit union, doesn't actually hold all of the deposits that we have in the bank. They hold only a fraction of them. Now, they're strictly regulated by the Federal Reserve of how much they have to hold. But essentially, the banks make money by lending out money. So they're trying to lend out as much as they possibly can. Now, that's actually going to have an important role when we start to look at how money is increased in the economy. And that's something that we're going to pick up with in the next video.